Well, good afternoon, everybody. My name is Rich Harvey, CEO of Propertybuyer, and welcome today to our webinar. Thank you so much for joining us. We really appreciate you spending the time with us today. So here's the agenda for the day. I'll just share my screen very briefly with you. So what we'll be doing today, I'd like to introduce my other guest, Theo Chambers, who's the CEO of Shore Financial, Australia's top mortgage broking group. They are fantastic. A lot of our clients use them and find them brilliant for getting loans. And also like to introduce Daryl Smith from MadeComfy. Welcome, Daryl. Daryl runs the short-term rental company, and he'll give a lot more details in that process in a minute. So, agenda for the day. I've got a bit of a joke. We've got a sign near our back door. Agenda for the day is let the dog in, let the dog out. But we've got a much more exciting agenda here today, which is talking about the short-term rental strategy and how you can maximize your yield through that process. Secondly, I'll throw to Theo in just a moment who'll talk about some of the financing implications of doing a short-term rental. And then we'll go to, actually, I've got it around the wrong way. I'll do some buying tips on what to look for in short-term rental success. And then I'll throw to Daryl, who'll take you through a lot more of the data and how the short-term rental process works. So yeah, it's great to have you all on board. I'm going to throw over to Theo, if you'd like to share your screen, Theo, and take it away, please.
Yeah. Hi, ladies and gentlemen. Thanks for having us and thanks for joining us, I should say. Um, just sharing this 1 second. All right, I think everybody can see that.
That's great, mate. Absolutely.
So, I guess the purpose of our content for today's webinar is sort of give people comfort and visibility on their options around financing, these holiday rentals and some key considerations. It is a little bit different from financing a regular purchase. Well, it is and it isn't. So I'll sort of start off by just saying, obviously, everyone who's been through the loan process understands that it's the serviceability is the main hurdle for most borrowers to overcome in the eyes of the banks. And when it comes to verifying income from holiday rental type properties, it can be a little bit sort of tricky as such, in the sense that generally banks like to use historical income. So meaning they want to look at tax returns to see a year or two, ideally 2 years worth of history of that holiday rental. Now, obviously, you're going to say, well, hang on, if I'm purchasing a property that's going to be a holiday rental, how do I show sort of the historical rental income or holiday rental type income? Sometimes you may be able to show if the property was previously a holiday rental type property, you may be able to show the previous history of that property. However, generally that's not accepted. What you'll most likely end up doing is just using the normal long-term rent if it was to be rented on a 12-month lease and just factoring the normal weekly amount. So you can't normally factor in the potential income is because it's so hypothetical as such. You can only really use the historical income once it's actually in place in your name and you're producing your own tax returns, which is really only for the purpose of refinancing, not for the purpose of purchasing it. Which is not doesn't rule out your options, because generally a lot of these assets still have a 3 to 4% gross rental yield that you can use, which should get you over the line. Other things to consider: some lenders will cap the yield at 6%. So there's some very high yielding holiday rentals that could get 10%. Banks see that 10% as a little bit bullish, and they don't really want to accept 10% because it does fluctuate some years. I've got a holiday rental property myself, and I've definitely seen it fluctuate. So generally, a lot of banks will cap it around 6% for the purpose of servicing. Just like normal rental income, they also do shade it. Most banks shade. What I mean by shading, it's like a discount that they'll accept of the overall amount, just to be conservative once again. They'll do that for long-term rentals. They normally shade normal long-term rentals between 70 to 80%. Holiday rentals, it can be anywhere from 50 to 75%. So once again, this does really vary amongst banks. So you do definitely want to shop around and make sure that your bank that you're with is giving you favorable terms to assessing serviceability. So I guess property use restrictions. So some people think that you could go buy one of these bed and breakfast type properties that is like a room by room type arrangement. That's a commercial property generally because it's more like a business that's being run out of there. If you're buying a normal residential property, that's fine, meaning a house that's being rented out as a holiday rental or an apartment that's being rented out as a holiday rental, that's fine. Even service apartments are acceptable. Some banks go up to 80% for them. The one caveat to the serviced apartment is that most banks want to see, or all banks want to see, that the serviced apartment can be released from the letting pool. So what I mean by that, there's some serviced apartments, for example, going in at Byron Bay. We're seeing quite a lot of purchasers looking at those Byron Bay total holiday rentals, and they can't be released from the reception that manages it, like the body corporate as such that manages the whole building. So that's a restrictive management agreement, and banks aren't comfortable with that. They want the ability for the landlord to say, no, I want to manage the property myself or appoint a different manager. Um, that's pretty much it on the serviceability. We'll take questions on the end, but in terms of acceptable security, so if you're purchasing a property that is not currently being used as a holiday rental and it's just a normal residential property, even if it is currently being used as a residential a holiday rental property, but it's a normal residential property, then there's no different sort of LVR requirements. It's just like a normal investment purchase, meaning you can purchase up to 90% of the property value. If you're purchasing it as an owner-occupied property, which you then might decide to do holiday rentals, you can even go up to 95% of the purchase price. So there's no real hurdles from an acceptable security point of view, providing it's that sort of standard residential property. If it's a service apartment, like I mentioned, or if it's a boarding house or any of these other sort of odd securities, that they might change slightly. Using equity to purchase the property, that's quite a common structure. So what I mean by that, you might own your home, you might have a small mortgage on it, but you might have significant equity that you could use to then access to borrow a holiday home that you want to use yourself and also rent out as a holiday rental. That is an ideal sort of structure and strategy to implement because it's optimal for negative gearing benefits rather than using cash that you might have in your offset account against your home. So what I mean by that is that if you use the equity and try and borrow the full amount, could be 100% plus cost, so stamp duty and any other fees associated with it. Could even be some extra cost for furnishing the place. Then you're essentially fully gearing the amount, keeping your cash in your offset account, which on the offset against your home is a non-deductible debt, minimizing your non-deductible debt and maximizing your deductible debt. That's a ideal sort of structure. And it's really crucial. Rich and I, we do these webinars all the time, and something that we always say, it's really crucial to get the right advice before you transact because these transactions and the way you structure it can't be changed easily afterwards. You need to put the right structure in place at the point of purchasing the property because you can't just top up the loan later to pay yourself back. Um, and on that note, I guess on structuring, offset accounts and redraw facilities. So I'm not sure if everybody understands the difference between the two, but just as a quick sort of refresh, redraw is the facility that's against the loan. So when you pay money into the loan, additional payments into the loan account, that is, then the surplus available funds will appear in the redraw for you to access and withdraw later if you wish. A better alternative to that sort of structure is a separate offset account, which is a fully transactional account that you could have the holiday rental income going into, your mortgage repayments going out of, and all your sort of debits and credits and such going in that one account. It also makes it easier then for just bookkeeping and sort of tracking and accounting. So if you have a zero profile, for example, you can link that offset account as the zero account so that you can have a nice, clear P&L that you can look into on a daily basis and sort of get visibility on how your holiday rental is tracking, especially with all the expenses that you might be putting through the property, because a lot of people like to sort of maximize their deductions and make sure that they're declaring all the appropriate expenses. Um, I guess that's pretty much it. I won't go into too much on those ones, but offset account in a nutshell is probably the preferred account of the two. Um, so this is becoming a more and more of a common question these days, whether I should buy an investment property in my personal name or whether I should be purchasing the property in a trust or company. Um, it's case by case, and we can't give you that advice in this webinar on what's best for your situation. But there are some important considerations, I guess, for either. The one big call out, I'd say, I won't go through these points line by line, but in a personal name, the one big call out is probably that last point being that it's optimal for investors looking to utilize negative gearing. So what I mean by that, if you purchase a property in your personal name, and with depreciation, with your expenses, it is negatively geared. You want that loss in your personal name. If you purchase the property in a trust or a company, those losses are sort of hived off in that company or trust, so you don't get the negative gearing benefit. However, there are ways to take advantage of a loss that's in a trust or a company. If you're self-employed, you can cross-charge between companies. It's a bit of a case by case, once again, like I was saying, but it's just you've got to once again look into these considerations before transacting because you can't change this afterward. What's common and sort of appealing about the trust and company sort of structure is becoming a lot more sort of common in today's sort of strategy of rent vesting and whatnot. You preserve your borrowing capacity when you purchase a property in a trust or a company. So when you purchase an investment property in your personal name, the debt is always going to be factored into your future applications. Whereas if you purchase a property in a trust or company, the debt isn't always factored in. You can exclude it with certain lenders. And that's a huge sort of value add for a lot of investors that are looking to optimize their serviceability for future purchases. Um, Apart from that, yeah, there are some other considerations like, trust might work for you. Going back to my point about moving company profits around if you're self-employed. So you might be able to come up with your deposit in a more tax-effective manner in a trust. But once again, best speak to your accountant and confirm best options for you. Um, Lastly, leveraging equity. So I think I already sort of touched on this, but there's a lot of our investors ask, whether I should use the equity. There's two different options to use the equity. You can either do a cash out loan against that property. So to put numbers on it, let's say you've got a $2 million home with a $1 million loan and you want to access $500,000 as a deposit for your investment property. The two different options is that you could use a cash out loan of $500,000 against that home, and that would be a separate loan facility that you could use towards the purchase of the investment property as a deposit. Alternatively, you can cross collateralize and just borrow the full 100% plus cost as one loan for the investment purchase that's secured against both the holiday home and your home. Some people think that the latter is not ideal for asset protection. So accountants might say, oh, if you cross collateralize, then the bank can come after both assets. That's a little bit of an archaic way of thinking, because if you read the fine print, no matter which way you structure it, the bank can come back and claw back their debt one way or another. So it doesn't really make a big difference. I'd say if you didn't have the deposit for the sake of keeping things neat, doing the cash out loan is wise. So you have the funds up front and ready to exchange with as a deposit. Um, Choosing the right loan product. So I guess the key consideration with principal and interest versus interest only is cash flow. Obviously, interest only repayments are going to be less than principal and interest, and also any offset balances any balance in the offset. It'll actually change the repayments on an interest only repayment. It won't change the repayments with the principal and interest. So offset balances do not change monthly repayments with P&I repayments. Fixed versus variable, once again, it's sort of case by case and also a very subject to the point in time you're transacting. So right now, interest rates are decreasing. We've had 3 rate cuts this year. The fixed rates, I feel, aren't as appealing as the variable rates because they're not quite, they're pretty much on par with variable rates when we're expected rates to keep going down. I've already sort of touched on the offset or redraw, but I would strongly suggest that an offset is the appropriate product for this type of investment strategy. Um, and that's pretty much it from us. Didn't want to go on too much, but we can save some questions for the end, right, Rich?
That's right. Yeah, thanks, Theo. That's wonderful. So if you want to contact Theo, just get your phones out, scan that code there. We will be sending out a copy of all the presenters' slides today, and also a copy of the entire recording today. So don't feel if you haven't missed anything, if you haven't written notes, that's okay. We're sending it out to you. So thanks, Theo. Some really good points. And I've got some questions for you that I'll save for the end as well. Yeah. Um, all right, I'll just share my screen. And just give me 1 second and I'll get stuck into it. Here we go. So, yeah, like I said, if you've got any questions too, please just write them into the Q&A box at the bottom of the screen, please. And we will have at least 10 to 15 minutes of good Q&A after Daryl's part of the presentation today. So, um, all right, so screen is just give me the thumbs up, Daryl. That's showing. Slides okay? Yep, thank you. Perfect, thank you. So won't go into our credentials except to say very proud of my team having won a bunch of awards over the last 25 years. But what I'd like to talk about today is, why should you consider a short-term rental? What's some of the key reasons why you'd consider doing this? And I'm going to talk about my own journey of converting one of my properties into a short-term rental using MadeComfy today as well. So I think one of the key reasons was already touched on with Theo's presentation, it's going to give you higher yield. So we're starting to see interest rates coming down. We're seeing a lot more investors entering back into the market. I mean, our own inquiry level at Propertybuyer is certainly increasing with a lot more investors coming back. We've seen tourism numbers really jumping up, not just because Robert Irwin's now on the new advert, but a whole bunch of other reasons. Australia's still a great destination to be. And every time I go overseas, I go, gee, I'm lucky to be an Australian, right? It's a great place to live. But also the gap between a long-term rental and a short-term rental is very significant. So even though rates are declining, a lot of us have felt that pinch, haven't we, Theo? Like we've all felt that pain of, 6.5% interest rates and cash flows tight. And, what if you could have a portfolio that's self-sustaining and positive cash flow? Wouldn't that be just great? So what short-term rentals does, it significantly increases the yield, as you see there on the slide. Long-term rental, LTR between 3 and 5% on average, but short-term rentals, 6 to up to 12%. So massive difference in cash flow. And it's really good to have a bunch of different types of strategies in your portfolio. So basically, this is just a model example. Again, we've created a portfolio tracker. So if you want a copy of our spreadsheet and also our retirement calculator, just shoot me a note. I'm happy to share these spreadsheets with you. But you can essentially want to be getting a bunch of properties here, and get to a certain point where you've got huge amounts of equity, but huge amounts of cash flow spinning off. And a lot of people think they can retire on one or two properties. I'm sorry, unless they're really high value in high commercial properties, you're not going to do that simply. So you've got to buy a number of properties to achieve that goal. So let's look at the pros and cons. Like what's the benefit versus what's the cost? Yes, it is going to cost you money to do this, but essentially on the pro side, on the benefit side, it's going to give you higher yield. It's going to give you higher cash flow. If you want to use it as a holiday destination occasionally, great. There's an option to use it there. You can't charge yourself rent, obviously. And a lot of these lifestyle locations, particularly Daryl will highlight a couple later on, they're in really good, strong capital growth areas too. The other thing is, with all the regular in and out of the short-term tenants, the place is going to get inspected every time and cleaned really nicely every time. So there's better maintenance and upkeep on the property. And by putting in a furniture pack, you're going to get much higher depreciation on the property as well. So they're the key benefits. On the flip side, there are seasonalities. And again, Daryl will show you a slide which you're going to get a peak, obviously over the Christmas period, over the Easter period, and there's a bit of, probably a drop off possibly in winter, depending where it is. Now, you've got to make sure that if you do a short-term rental, that it's compliant with the local council regulations. Theo mentioned Byron Bay, where there's a limit on Airbnb for 180 days a year for non-hosted Airbnb. So in other words, if you don't live there, you can only rent it out for half the year. So a lot of councils really want to make sure that there's enough long-term rental accommodation as well as short-term. And you're going to have to buy a furniture pack. Yes, you're going to have to pay management fees, circa 20%, but it's going to be intensively managed. But the bottom line is it's worth it. Even after all the fees, it's still worth it. And I'll show you a live example in a minute. So yeah, so this is look an example. Again, I'm just going through this process right now. So I'm actually a bit of a test crash dummy, the canary down the mine, if you want to call it, Daryl. We're doing this ourselves, and this is one of our properties in Brisbane. This is a townhouse. It's actually a dual townhouse here. We're turning one side of it into a short-term rental. We built this about a year ago. Really nicely specced out. It's a four-bedroom townhouse, 2.5 bathrooms in a location really close in the sort of middle ring suburbs of Brisbane, really close to one of the hospitals there. So we're expecting to get, a bunch of families potentially. It could be, workers for the between accommodation, maybe families, whatever, need short-term accommodation. So, really good layout. So here's our property. As a long-term rental, it's going to bring in about 54 grand a year. So it's about just over $1,000 a week, $1,050 a week. Now, as a short-term rental, it's almost double, more than double what it's going to bring in, 121 grand a year. Now, I'm not going to get 121 grand into my bank account. I've got to work out the occupancy rate. So you can see here we've got potentially a range between 62 to 74% occupancy rate. And then you've got to deduct management fees. So it's going to dramatically increase the revenue, but the net is still worthwhile. So here's the net. So if we look at the long-term rental, it's probably going to net me about 48, but potentially I can be getting up to 73 grand a year. So that's potentially a 25 grand increase per annum in my pocket. So, after 4 years, that's another 100 grand. Now that goes a long way to helping to pay down the loan and turning this property after 10 years into a nice little cash cow. So again, I've had quite a lot of reservations, being honest about this process. Is there going to be enough tenants? What's the demand? Is it worth the cost? Paying this 20% management fee, is it worth it? And at the end of the day, for me, yes, I've answered yes to those questions. So it's been an interesting journey. I want to give you a couple of buying tips, if I may. Like what particular geographic locations makes for a good short-term rental. A couple of key things to look for. So obviously near major attractions, so like natural attractions like waterways, beaches, bays, things with great views. Near hospitals potentially, so people visiting loved ones or that sort of thing. But particularly walkability, be able to walk to the train, walk to the bus stop, walk to the cafe precinct. They're very important things that will generate a much higher short-term rental return. And also critically low vacancy, which means higher occupancy. You don't want to be buying in an area where there's not a strong demand for those kind of properties. And as I said before, I'll reiterate it again, you must triple check the council regulations to see if they're allowed. Now, some councils may charge 5 grand or 10 grand for you to get a permit for short-term rental. Again, just put that into your calculations and go, is it worthwhile? And possibly it's going to be worthwhile if you're going to get a good payback period. So there are a couple of tips there. In terms of where to buy, in terms of like, say, New South Wales or other states, just remember there is a cap, 180-day annual cap for a lot of the Greater Sydney area for where you're not living in the property and hosting it there yourself. There's no cap in most regional areas. For Victoria, just remember there is a 7.5% levy on short-term rental bookings. Now, Queensland's a really good spot to do short-term letting. There's no particular restrictions there, but certainly the Gold Coast requires you to have a registration there. But I won't go through all of those, but just again, check the state and the legislation and also the council regulations to make sure it can be done. It's not like a blanket policy. You can do it everywhere. Okay, so what property types work best? Look, again, I wouldn't be putting up, something that doesn't suit the demand for the area. So a couple of tips. Again, I'd talk to MadeComfy and they'll do an analysis for you, but talk to some local property managers and see what sort of demand there is for short-term rentals. It can work in apartments, can work in townhouses, can work for houses. But some of the key things I'd suggest the property has in terms of features is easy parking, good privacy. So make sure it's got good separation from neighbours, good aspect, good light, it's not dingy. But particularly when it comes to putting in a furniture pack, getting something that's stylized and looks classy is going to get you a much better return, isn't it, Daryl? Like we
Yeah.
know that when you do something that's a bit average, it looks like, something from, what's the cheap furniture rental? Not IKEA, but one of those cheaper, you know, furniture groups. It's going to look
Fantastic
cheap and
furniture.
nasty. So get a quality furniture pack that's going to last the distance and looks good. Pools or especially entertainment decks or balconies are really important. And of course, the obligatory barbecue. Right? Everyone loves to cook a steak out in the barbie, right? They're on holiday, so and it won't stink out the house. So make sure you've got that as well. So hopefully that's given you a couple of key tips there. In terms of trying to find a particular property, that's certainly something a property buyer can help you with. And we take all of our clients through this seven-step process. Whether you're buying a long-term rental or a short-term rental, these are the seven steps that we go through with you. We help you create a strategy. We help you pinpoint the specific market where it's going to work. We then identify specific properties and shortlist them for you. We evaluate them. We complete due diligence on it, and then we negotiate the lowest possible price. And then we coordinate with MadeComfy to get it tenanted and rented out at the end of the process. Certainly you can do it on your own, but there's a couple of, DIY versus using a buyer's agent. Again, I guess the key benefit, if you are thinking of doing this, of using a buyer's agent, is that we can speed up the process. We can certainly add a lot of value in terms of the local knowledge of the local market and particularly negotiating, knowing what value to pay. Like we're now moving into a market that's going to be a lot more competitive. We didn't talk about the new 5% deposit scheme that the government's now bringing in for first home buyers. That's going to accelerate the demand for low-end property through the roof. So there's going to be a lot more people competing for properties, and we know there's a housing shortage. So yeah, there's certainly some key benefits there in using a buyer's agent. So look, if anyone is interested on the Zoom today, you can scan that code there, that QR code. And again, my offer today is for a 30-minute obligation-free complimentary chat directly with myself. I don't normally do this, but I'm happy to do it directly with myself. So if you scan that code, you can book a time directly into my diary for up to 30 minutes, and we can talk about your portfolio, how to build it, whether short-term rental is the right thing for you, and just discuss how to help you move forward with confidence. So please take advantage of that if you'd like it. I won't go into too much more. I'll send these out a bit later on. But I guess what else can I tell you? I think that's about it. So, I stop sharing on there. So, Daryl, I finished at 1 o'clock. How's that? 15 minutes, mate. Bang on.
Excellent. Thanks. Thanks,
I will hand
Rich.
over to Daryl now. He's going to give you a lot more detail about MadeComfy and particularly how the short-term rental process works. So thanks, Daryl.
Fantastic. Thanks, Rich. There's some really great tips there from Rich and from Theo. Some really interesting stuff there on how to set up the right structure, which is critical, I would say, with your short stay investment property. Okay, you should see that up on screen now, Rich.
All good, mate.
Okay, excellent. So thanks, everyone. Thanks for having us here today. I'm going to run through a few slides, just kicking off a little bit about who we are, MadeComfy, and then I'll dive into the data a little bit later. And then we'll highlight, like Rich did, a couple of the hotspots, some of the areas where we find are the best for short-term rental. And then at the end, we'll give you access to a calculator where you can actually punch in your own property, etc. And ideally, if any more advice you want after the call, please just reach out to Rich, reach out to Theo, get the right structure, get a professional to help you find the right property in the right area, and then engage MadeComfy or self-manage to look after that short stay property. So a little bit more about MadeComfy. We've been running just over 10 years. We are Australia and New Zealand's most awarded and largest short-term rental end-to-end professional service provider, backed by some major investors, including SoftBank, Microsoft, Airbnb, Lightspeed Ventures. And more recently, we've been acquired or become a part of Oyo Group, which is a very large global short-term rental specialist. They specialize in boutique hotels, with managing over 175,000 boutique hotel rooms and over 50,000 vacation rental and short-term rental properties in over 35 countries. So quite a significant portfolio there globally. As MadeComfy, we managed just over 1.8 million guests in our properties to date, and we're operating in 30 plus core markets across Australia and New Zealand, and some smaller submarkets. Below are some of the platforms that we're currently advertising on. So why short-term rentals? Why do people get into this space? So the feedback we've had from our clients since January this year, 57% of those clients and investors are really looking at maximizing the returns. So as Rich touched on earlier, really getting the maximum yield, the maximum rental income, which increase their serviceability so they can go again and buy another investment property. 28%, and typically post-COVID, we've seen this shift. 28% now are looking for flexibility. So come for work purposes, use it as a holiday destination during school holidays, but having that flexibility to switch between short stay and long stay potentially and use their investment properties is becoming a key factor, especially for work purposes. And then the last part, 15% of those are DIY clients. So investors who are either self-managing or engaging a local co-host, now looking for professional management service and choosing to shift or switch over to a professional, fully managed service model. An interesting fact, 92% of the clients that we work with are actually new to the sector. So these are people that are shifting from a long-term, potentially they've just bought the property, it's been on long-term, but they're shifting it to a short-term rental investment strategy. So some of the unknown kind of facts and data behind short stays, it's actually the second largest accommodation sector globally. A lot of people think it would be serviced apartments, hotels, B&Bs, but hotels globally are sitting at 820 billion US dollars as an industry or global market size. Short-term rentals follows that with 140 billions US dollars. So it's a significant market size. If we look at just Australia and New Zealand, there's about 250,000 plus market properties currently in the Australia market. So those are active Airbnbs and short-term rentals. New Zealand sits at about 60,000. So we're edging just over 300,000 in total. So it's quite a large property market size. And then in terms of growth expectations, annually, it's growing anything between 18 to 22% at present. And in the ANZ market, we're looking at the expectation for 2026, looking at about a 24% growth rate. So now is an ideal time if you are thinking about getting into the short-term space. It's still quite early stages. I would definitely recommend now is a good time to get in. Another misconception or another area that's quite topical, why do people choose short-term rentals over hotels? So when you book a hotel, there's two sides. One, from a guest perspective, everything's in one space. So you're living, cooking, watching television, trying to do your work, etc., and sleeping all in one space. So if it's for one night, maybe 2 nights, that is convenient, and a lot of people go with the hotel model. But if you're starting to look at extended stays, living in a small space like that can be quite constrictive. So a lot of the driver for moving to short stays is having separate kitchen areas, having separate living space where you can relax, watch television, then having a dedicated workspace, but also being able to cook. So cooking in the apartments, having a washing machine, being able to live for longer periods of time is a critical element of why people shift towards a short stay. If we look at this particular example, we've got a 4-star hotel, typical in Darling Harbour, and then we've got a MadeComfy property with a 1-bedroom investment property in Darling Harbour. From an investor perspective, a guest would pay roughly 300 plus a night. So 6 nights, you're looking at just over $2,000 to stay in a hotel. By comparison, 6 nights in an Airbnb or a short-term rental property would be a little lower than hotels, so very competitively priced, but it's $1,850 for just shy of a week's stay. As an investor, this would be a $750 a week long-term rental property. You're more than doubling your rental income. So it's very attractive as a short stay proposition for an investor. And for a guest, it's obviously a much more comfortable stay. In terms of what we look for, Rich touched on this a little bit earlier, but the key drivers that we look for in MadeComfy and professional short stay properties, fully equipped and nicely designed or well looked after renovated kitchens, laundry facilities, comfortable bedding and linen, and Rich touched on that as well. Furnishing packages are critical for your performance. And then unique things like balconies, outdoor spaces, and then a big driver more recently has been the work from home space. So people being able to live in somewhere like inner west of Sydney, commute to the city for 1 or 2 days, but then live and work in their short stay apartment is a very desirable amenity that they're looking for. Renovated kitchens and bathrooms, separate dining and living spaces, And then anything else that's unique. It might be the way it's styled. It could be an outdoor space. It could be a view. And that's typically what we would look for in a corporate home or a professionally managed short stay property. Some of the investor insights, things that you should be looking for when buying a short-term rental. Car space. This is quite topical. Do you need a car space? Yes and no. So you definitely don't need one, and it's not as critical as in the long-term rental world. If it's a one-bedder or a studio, definitely not essential. I would not overpay specifically to have a car space. As that configuration increases, 2-3 bedroom apartments, 4-bedroom homes, your target market is going to be families. It's going to be larger groups traveling. They more typically would be interested in having car space, and car parking would become more essential. Prioritizing walkability, so close to public transport and proximity to major events, hospitals, event venues is important. Don't be turned off by an outdated kitchen and bathroom. Obviously, small cosmetic renovations are possible and quite an easy thing to take maybe the worst property on the street and turn it into a very attractive property if it's in the right location in the right area. Checking local council rules, bylaws, etc. are important. Don't chase the floor plan, so it's not necessarily the biggest property, but rather go for the quirky design, a 1.5 bedroom property that you can turn into a 2-bedder. So look for things that are unique and the design of the property rather than purely space. And then things like, we definitely love a balcony in a work from home space, as I touched on earlier, very, very important. Amenities like pools and gyms, yes, it might add a bit of an extra cost to your purchase, but it's definitely an amenity that guests would search for. So a long stay as a corporate, one-bedder in an apartment building, you'd be looking for things like a gym, and you'd definitely be looking for things like a pool if you're traveling with kids and family. Some of the core metrics that we would use when analyzing short-term rentals. So we analyze all the market data. We would look for occupancy. High occupancy is critical to generate the right amount of return. The average daily rate, or the ADR, is important. Then RevPAR, which is revenue per available room. A one-bedder may, in an inner city market, actually be a better investment yield-wise than a 4-bedroom house in a very seasonal market. On a per-room basis, if we look at the actual returns, a one-bedder could perform better than a large home. The gross monthly revenue, obviously that's very important. And then secondary metrics, which are on the smaller side, would be average length of stay. So how long are guests typically staying in these properties? What is the booking window? How far out are people actually booking? Is it all last minute, which drives lower pricing? Or are people booking well in advance, which secures your premium on those nightly rates? And then the average bookable properties. So the number of properties available in your area and the competition levels. Then just looking at your investment property and your actual searching process. Obviously, Rich can provide a lot of the more micro level detail, market and economics, etc. But ours is a very data-led approach. So we buy all the live market data, typically from the bigger platforms. So Airbnb, Booking.com, Vrbo. We collate all that data, and we're analyzing over 26,000 different suburbs across Australia and New Zealand. We're also looking at our active properties. So more than 1,400 active properties across over 1,000 postcodes where we operate across Australia and New Zealand. And that's how we're analyzing that data. And then we're building the 12-month revenue projection, giving them both the long-term rent and the short-term rent comparables. In seasonal markets, we would also draw on things like mid-term rentals. So that's looking at the realestate.com and the domain.com and potentially having your property advertised for slightly longer corporate executive stays, up to 3 months at a time. If we look at a quick snapshot, market pulse, region by region, some of the top performing areas and areas where we operate, Sydney and the New South Wales coast, very high demand, lower competition in some areas like Sydney, predominantly driven by the 180-day cap. And just to explain that cap, it doesn't mean you can only rent your property 6 months a year. It's only specific to short stays. So anything less than 21 nights would fall into that cap. Anything in a mid-stay, which is more than 21 nights, does not count towards the cap. So it definitely doesn't mean you can't invest in somewhere like Sydney and you can't have 90% and 300 days a year booked. So that's a really important factor. Areas in Melbourne and Victoria, this is a very event-driven market. You see a lot of big events like the Australian tennis, the F1, huge concerts like Taylor Swift, etc. So it tends to have a lot of peak periods, but throughout the year, constant demand, both from international and domestic travelers. Queensland, everyone knows Queensland, Gold Coast, Surfers Paradise, very, very popular for tourists. Again, international and domestic, but an all year round market. We see a lot of Kiwis coming over into the Sunshine Coast and potentially living for 3 or 6 months during their winter period and having that flexibility to have an investment property in the Sunshine Coast. And with the Olympics coming up, 2032, we see a huge drive both from tourism, but also people living and working, building infrastructure, roads, tunnels for the next 4 years in order to get Brisbane in particular ready for the upcoming Olympics. Adelaide, a growth market. That property investment cycle has moved swiftly over the last few years into Adelaide. It's also more recently moved into Perth, which are quite new markets still, and I would say untapped for the short-term rental investment model. East Coast is quite established in short-term investment, but Adelaide less so, and Perth very new still for investment, so a lot of opportunity there. Tasmania, again, I'm going to touch on some hotspots where we would definitely look at. Things like hospitals, a big driver. Doctors, nurses, and locums coming to places like Hobart is what's driving the rental demand in those areas. Reviewing the last 12 months, our properties in total have generated a net revenue return of approximately 32% higher than the average long-term rentals. So that's a significant jump. Obviously, it's not applicable for all properties, but as an average, that is a significant jump over what you'd see in the long-term investment market. Some of the gems or the hotspots that we've identified, we will send these slides out, so I'm not going to go through in great detail. But areas like Hobart, Margaret River, Fremantle in Perth, Blue Mountains, Coffs Harbour, Adelaide Hills, Darwin, Fortitude Valley, Canberra, South Melbourne, Inner Melbourne, Burleigh Heads, and Coolangatta on the Gold Coast are some of the key areas where we see the highest yields. I'm just going to touch on one for the purposes of today, which would be Fortitude Valley, which again, driven by the demand for the upcoming Olympics and being an inner suburb in that kind of inner ring, not quite inner city, is definitely one of the highest demands. And I'll explain just what all the different columns are. So the average nightly rates sitting at $272, average occupancy 70%, really, really good. So we would always try and target 70% plus in any investment market. The median purchase price for 2-bedders, specifically for this example, $665,000. The annual rent it would generate in the short-term market, $69,000 versus only $31,000 on the long-term rental market, which is a 10.44% yield for short stay. By comparison, it would only be 4.6 or 4.7% on the long-term rental market. So it's more than doubling the rental investment yield. And that is an area where you can still buy pretty well. You're sitting at under $1 million for 2-bedroom investment properties. Some of the other key markets that we've highlighted and where we know investors are doing really well would be Adelaide, Perth, Brisbane, Melbourne, and then New Zealand. So there's a few New Zealand or Kiwis that have joined the call today. Some of the areas there where we're already active and we see high demand. So Auckland, Queenstown is a huge booming market all year round. There's super high demand from winter season and summer season. And that's a market that is going to continue to grow. And then other areas where we are already active, Hamilton, a lot of events there, Bay of Plenty, which is more holiday driven, Rotorua, Christchurch, and Wellington, both corporate and executive travelers, as well as leisure and domestic travelers. We also wanted to highlight a success story. So this is one of the clients that we've been working with over the last 2 years. They've seen over that last 2-year period a 65% uplift in their rental income. So that is a significant jump in rental income. On the short stay net yields, they're achieving around about that 8% at the moment versus a 4.89% on the long term. And their monthly rent net after all fees has jumped from around $3,000 per month to $4,982 per month. Annually, that's $36,000 on the long-term market net to $59,700 on the short stay market. This is not something that is particularly outstanding on the beachfront penthouse that has amazing views. It's just well positioned in the inner west of Brisbane. It's a new build, so renovated kitchen, bathroom, swimming pool in the complex. It's just a nice, good overall, good quality investment property. You can see some images here, what it looked like on realestate.com before it went to market, and then what it looks like now live on Airbnb. And I'm just going to jump into the dashboard and I'll show you exactly what this looks like from a calendar. Can you see the calendar, Rich?
Yep, all good.
Yep. So this is what we give access to all of our MadeComfy clients. This is the particular property. It's in Kelvin Grove in the inner west suburbs of Brisbane. All the yellow highlighted dates are actual bookings. So you can see this particular two-bedder has a very, very high occupancy. And then if we jump onto specific calendar bookings, it's not just short stay. So people are coming and actively living in this area. It's near a university. So it could be lecturers. It could be people coming for study purposes. But this is a 72-night booking. It's come through Verbo, one of the booking platforms. But people are not just coming for weekend trips, but they're actually filling up this calendar as an overall basis with really long occupancy. If we jump into the performance tab, we can see consistently over the last 12 months, it's driving 70 to 80, sometimes 90% occupancy on this particular property. And then if we go down to the net revenue, as an average, if we just look at July, it's sitting at around $5,000 net a month for a two-bedroom apartment, which is a really high yield and a really high rental income for a two-bedder in a I would say, middle of city destination. Just jump back into the slides. Okay, you should see the last slide up on your screen now. Anyone who's interested in finding out a little bit more about how much their property can potentially earn, or if you're thinking of buying an investment property specifically for short-term rentals and Airbnb, if you'd like to just scan that barcode, it will take you to a landing page where you'll be able to put in what your current long-term rent is, management fees, and then it will be able to give you a short stay projection, how much that property could earn gross and net per month. Anyone who wants further details, or if you've got specific properties and areas we haven't looked at today, please feel free, reach out. After this, we'll share the slides, but we're happy to run a 12-month revenue projection on any specific properties or give you more insights into how the end-to-end management service works. Thanks, Rich.
That's great, Daryl. Fantastic. If you just want to unshare your screen so you can just bring our faces up. Thank you so much. That's wonderful.
There we go.
Lots of great info there. I hope everyone's got value. I'd love to open it up now for Q&A, so I can see a bunch of questions there in the Q&A box, and we'll dive straight in them. Theo, I've got one for you in a minute, but I'll just go straight to the questions. Someone's asking, what is negative gearing? Pretty simple answer to that one is that if you take all the rental income you get, so you take all the expenses you have for owning the property, the interest rate, the management fees, and you're ending up making a loss, not a gain, not a net positive cash flow. If it's a negative cash flow, then you can claim that loss against your own personal income. Or if it's owned in a trust, then you can claim it against the income of that trust and get some tax benefits from it.
Can I add one point to that, Rich? Because it can be a little bit confusing. If the property is aggressively yielding, like let's say it's a 5 to 10% yield on the property, how is negative gearing even possible? Sometimes you can have a cash flow positive property, meaning that the rent is covering the expenses like interest and general maintenance, but you can still be negatively geared on paper, and that's because of depreciation and whatnot. So if you bought a property that's brand new, or if you've bought a property and added significant value to it and done a renovation, a lot of the time it could be cash flow positive, but on paper you're claiming a loss and it's negatively geared.
Good point. Thanks, Theo. Daryl, one for you. Which area in New South Wales is good to invest on for short-term rentals?
Good question. There's quite a few. Just depends if you're looking for an urban market or if you're looking for a more regional market. So as we move out of Sydney, the Central Coast is still a really strong investment area from a price perspective. And then as we move up the coast, So we're seeing some good yields in places like Port Macquarie, Coffs Harbour, and as you're moving more north, Pottsville, like right on the northern side. If you move south, probably somewhere like Kiama, Bowral, those are still good buys from a price perspective, and generating good yields.
How about Newcastle?
Ah, very, very good point. Yep. So we are active in Newcastle, and Newcastle I would definitely guide as one of the under and invested areas at the moment where
Mm.
there's a lot of opportunity,
Yep.
especially with the change in zoning there. We see a lot of medium density apartments around the Honeysuckle precinct in that inner city ring.
Mm.
Really good investment properties, or 2 and 3 bedroom cottage houses that can be converted into a short stay and generating high yield, but the price point is still quite low to buy in.
Excellent. Yeah, no, one of our team members lives up there. He's one of my buyer's agents. He's got his own Airbnb property doing really well out of it. So definitely recommend Newcastle.
Can
Um,
I add one more point? Sorry,
yeah,
Rich, that I
go ahead.
didn't quite cover in my slides, but it was
Sure.
in one of those bullet points. A real common thing that we see is a lot of people are buying holiday homes that they want to actually use themselves,
Mm,
but then they rent it out at the same time. And a common consideration in that sort of goal or ambition is that how does it work from a negative gearing or tax point of view? And this consideration is really key to understand because it makes owning a holiday home extremely viable and tax advantageous. How that essentially works is that it's not, if you're using it, let's say, 50 days a year out of 365 days a year, and it's only rented, and occupied 150 days, the amount that you can deduct of the overall expenses is based on how often it was available for rent. So you just need to apportion how much you used it, and then the rest of the year, not how much it was occupied, but the rest of the year, as long as it was available for rent, that can be deductible. So a lot of our clients will only declare that their holiday home is 10, 20% personal use and 80 to 90% investment use. So that 80 to 90% of all your expenses, like interest and anything else you do with the property, is tax deductible. That's a
mm,
key thing to understand.
that's good. I mean, it's fantastic, Theo. You've just answered a question from Peter Burton on an exact question, so it's all good. Um, we'll come to that in a minute. But how does capital growth for short-term rental compared to long-term rental? Well, the answer to that question, it's there's no difference. You're just renting it in a different manner. So, from a perspective of where to buy, it comes down to the overall strategy. So, what I say to people is, let's take a step back and think about what your overall strategy is. Do you want something that's going to provide really strong capital growth, or is the yield play the highest factor? Now, not to say they're mutually exclusive. As we said, you could potentially buy in Newcastle, or you could buy in Burleigh Heads, or you could buy in certain parts of Melbourne or Brisbane and do quite well. But in terms of it's just more around the strategy. So, Daryl or Theo, any other comments about the capital growth play?
Yeah, it's case by case there. Maybe I'll let Daryl answer that one.
Yeah, I suppose it comes down to their appetite. So if they're buying a lifestyle property purely for their own enjoyment, it may be Mornington Peninsula is a good example in Victoria.
Mm,
That may not be a high capital growth area because it's a very well established, but they're buying it because it's their personal preference of where they want to live potentially when they downsize, etc. When clients come to us, we do try and advise them to get a combination of both. Your best outcome is finding somewhere in a growth capital market. Bendigo, Ballarat is a good example in Victoria, where it's still a growth market. You may go there a couple of times a year, but it's also a high demand market for corporate business travelers, and you're going to get the cash flow and the long-term capital growth
mm.
side by side.
Great.
I think also, Rich, you touched on this, but where we've seen clients really optimize both the yield and capital growth is when they've added value to a property. Um, so if you bought, the ugly duckling, I think you called it on the street, the house
Yeah.
that's unloved, in areas, along the coast like Byron Bay, like we mentioned before, if you buy that house that needs some love and you add the value, not only will it increase the amount of bookings and appeal online that you'll get from a income point of view, but that's when you really get significant capital growth. When you've turned a house from a three-bedder into a four-bedder,
Mm.
or you put a pool in, there's huge capital growth and capital upsides usually from that.
Yeah, great. Actually, the tax question from Peter Byrne, and Theo, you might want to answer this
Yeah, I
one.
saw that. So
Yeah.
the CGT exemption, if you're renting out your primary residence, you're allowed to rent it out for up to 6 years and still be exempt from capital gains tax. Land tax is an interesting one. If you're if it's purely a rental and you're not living there anymore, then you will still pay the annual land tax. However, if it's a combination of the two and you're living there and then renting it out when you go away, or and it's still your prime residence, I'm pretty sure you can apportion the relative land tax to, once again, what I said on the 80 to 90% investment and 10 to 20% sort of primary residence or owner-occupied use. But that'll be a question for your accountant. But
Yeah,
you can
exactly.
definitely get out of the capital gains tax for up to 6 years.
Yeah. Now talk to your accountant. Daryl, what's your thoughts on northern New South Wales for an STR location?
Yeah, I think I touched on some of those. Port Macquarie, Coffs Harbour. It just depends how far north. Pottsville, I know we're active in that market, and that's a very popular holiday destination. You see a lot of Queenslanders coming down and New South Wales people traveling up. But yeah, that's a good market for us, northern New South Wales.
Cool. Yes, the webinar will be recorded and passed on to everyone. Alex is asking expected fee for a buyer's agent. Yeah, good question, Alex. We charge a fixed fee per price range. So under $1 million, it's the equivalent of 2%. And then between $1 million to $2 million, it's a sliding scale between 2% down to 1.5%. But just reach out to me and I'll give you a specific quote based on your strategy and what you need. Jeremy's asking, annual day limits is going to be imposed in London. Is this being discussed in Australian cities? Daryl, what's your thoughts?
Yeah, so the only area at the moment, major market would be Sydney, where I touched on earlier, the 180-day cap. We were a little bit behind the 8 ball with that one because it was rolled out without any engagement. Now that we have an ASTRA committee, which is the Australian Short-Term Rental Accommodation Association, we actively engage with local councils, with governments, and before they roll out new policies and procedures across other states, we do have a lot of engagement. We come to the table and give our suggestions. So we're very against having a cap. We're okay with things like a levy in any market because it's a tax deductible again and it can be on charge to guests, but definitely not a cap. So Byron Bay has got the worst, and I think it's down as low as 60 days now in some parts of Byron Bay. But yeah, we shouldn't see night caps rolled out in any other states besides New South Wales and the smaller little spots.
Someone's asking, what's the best type of property investment that minimizes the owner's involvement? Well, my simple answer to that is using a great property manager. For my portfolio, I have fantastic managers, and I authorize them to fix repairs up to $500, so I don't even know if a toilet's busted. But it's pretty simple. Get a great property manager. Is it possible to have positive cash flow? Absolutely. As you've seen through our webinar today, you can get some amazing yields, 10 to up to 15%, so 100% correct. How do you minimize hosting, listing, management fees? I think probably the answer to that question, Daryl, I'll just jump in and you jump after me, is that's probably the wrong question. It's not about necessarily minimizing the fee. It's about maximizing the return. So I always say to people, you get what you pay for. If you want to cut corners on your suppliers, your consultants, you're going to get what you pay for. So you pay a reasonable fee and you get a good result. So yes, these fees, like, your fees are going to be circa 20%, but as you saw the figures I've presented, it's worth it. Daryl?
Yeah, absolutely. What you need to take into account there, guests are prepared to pay a premium for a premium service. So as a guest, you book with a co-host or self-managed property. They disappear overseas on holiday. You can't find the key. There's no 24/7 guest support. It's a really frustrating experience for a guest because they try to find the cheapest Airbnb or the cheapest property. Whereas if they pay a premium and then they get the guest app, they're able to check in successfully, anything they need 24/7 during their stay, if they're able to get that, plus professional housekeeping, professional linen, it's well furnished with everything they need to cook and for their length of stay. People are very happy to pay that premium. So hence those fees, like you said, don't really make an impact. The platform fees, the management fees, that's all taken into account for that premium experience.
And I guess going back, it sort of relates to both questions there, Rich, if you don't mind me jumping in. Also, by having a good property manager, if you are buying, once again, a property that you want to occupy and use occasionally yourself, The worst thing to do is having to go to the property every time and spend the whole time fixing things up and giving the love that the property needs, which a property manager can implement for you. By outsourcing the management and having these expert property managers taking care of all that for you, when you go there, it's set up like a hotel for yourself, and you can actually just enjoy it like any one of the Airbnb guests does.
Yeah, absolutely.
I'm also speaking from experience because, like I said, I do have a holiday rental myself, and I feel like when I check into it, if I'm checking into a hotel, it's my own property. It's great.
Nice. Daryl, this one's from you. It's from Michael. Given the 7.5% levy in STR in Melbourne, is Melbourne still a viable STR opportunity?
Yeah, definitely. So we saw Melbourne go a bit flat and softer for the last 2 years, and I think that's general across long-term and short-stay investment. We saw quite a few people selling down investment properties in Melbourne because of the extra land taxes and levies, etc. The 7.5% levy for short stay does not actually have an impact on the landlord because it's charged to the OTAs. So it's actually charged to the booking platforms who in turn pass that on to a guest. So the guests are picking up that 7.5% as part of the rates that they pay to stay. It's not actually coming out of your deductible income.
Good question. I like this one from Fergus. Can you circumvent the 180 days by subletting the property to a third party who then lets on the short-term platforms?
That is a good in Sydney, I presume you're talking about.
I'm not sure. He hasn't
Yeah.
specified where.
Yes, we've seen some people in the market, they do that more on like a whole building level, where someone takes a head lease and then they're able, because they have a different commercial agreement there, they're able to let that out.
Yeah.
The way that we do it, we wouldn't recommend that. The way that we do it is that we have a very specific pricing strategy where we advertise properties for longer lengths of stays further out and obviously shorter stays within a 90-day window. And that allows us to also bring corporate bookings. So anything longer than 21 nights, like I said, is for us is a mid-stay corporate booking. And we balance our calendar between longer stays and short stays so that we never reach that 180-day cap, and we can still run at 90% occupancy throughout the year.
Okay. Got one.
There's a few questions there about the SMSF, if I should jump in there, Rich.
Oh, go ahead, mate. Yeah, go ahead.
Yeah, so a lot of people are asking, can you use SMSF for this strategy, and how does it work if you want to use the property yourself? Yes, we see a lot of people buying holiday type rental properties as within their SMSF. The grey area, and it's subjective to your accountant's opinion, is whether you can use it yourself. Now, technically, you can't use a property in your SMSF yourself, as in you can't occupy it. However, you're allowed to buy an office and rent it to yourself in your SMSF. So some accountants take the view that if you rent it to yourself and you just pay rent every time you stay to the SMSF, then that's fine.
Okay. Yeah, and we see a lot of our corporates doing that. So they will buy, in Canberra as an example, an investment property for work purposes. They're there 2 days a week, and they have an allowance for accommodation. So we can actually provide an invoice for them, and they're paying for cleaning fees, etc.
Excellent. Pet friendly. Are any of the Airbnbs pet friendly?
Yes, definitely. So we have pet friendly on a number of our properties. And post-COVID, we've seen a lot of people buying furry friends during COVID. So we see a lot of people traveling with pets. So that's quite a high demand with a lot of properties.
Awesome. Theo, one for you. Someone's asking, with 105% loan with equity, can the property still be positively geared self-sustaining if they use the MadeComfy process?
Well, if you think about it, the purchasing cost now after the most recent rate cut, you can borrow money just over 5% now. And if you're getting 6 to 7% yield, yes, it can be positively geared. But then again, going back to my original point, you could still claim a loss with depreciation if it's one of these brand new units or whatnot. So yeah, it's case by case, but you could be borrowing 100%, over 100%, and still achieve positive cash flow. That's for sure.
Cool. Lauren's asking, does the calculations include the cost of water, electricity, gas, internet, Daryl?
Great question. No. So those calculations, obviously, we don't know everyone's personal circumstances. So that would be something that you'd have to take into account separately. Electricity, gas, water, internet would be a landlord cost, but those are all tax deductibles. So important to just give that to your tax accountant so you make sure you can maximize the deductibles.
Got it. We'll just go for another couple of minutes, guys, another 4 minutes. Someone's asking, do you help purchase the property? Yes. So Propertybuyer, that's us. We help with the purchase of the property. terms of management for short-term rental, that's Daryl's department for MadeComfy. So it's a pretty simple here. We've touched on Perth. Let's have a look at a few others. How do we prevent guests from booking a property at a premium rate well ahead of time, then cancelling a few days and rebooking it at a reduced rate? Daryl, how do you do that one?
That's a really good question. Obviously, that's a question more directed at the pricing and revenue team. That's and it's on the same platform.
Yeah, you can change the settings in the platform for cancellation policies. So if you've got a flexible policy, you can give a full refund, but you can have a strict policy which will only give a partial refund up to a certain period out. And then if it's within 30 days or a certain period, you can sort of select to give no refund.
Yeah, absolutely. So yeah, we have all of ours, depending on which platform, like you said. We also have some non-refundable. So like the hotels, we now have options there. If you want to book a slightly lower rate in advance, you get the non-refundable, which means the landlord's protected 100%. Otherwise, 30 days, 14 days, and 48 hours before, different refund and cancellation policies. The stricter you are, the more you keep, I suppose. But also guests would have more options the more flexible you are. Post-COVID, you had to be flexible. If there was no flexibility, people just wouldn't book the property at all. That's eased up now. So you can be a lot stricter now.
Cool. Daryl, in my presentation, I put up the two charts of the conservative estimate and the optimal estimate. Just can you explain the difference between those optimal and conservative estimates, please?
Yeah, sure. Absolutely. So the way that we analyze all the data, we look at if it was a two-bedder, like the one I did in Brisbane, a two-bedder in that specific postcode. We look at the market data shows us over the last 12 months, all the two-bedders, what they achieved. So booked rates, not the advertised rates you'd see on Airbnb, but the booked rates for the property across the different seasons and the occupancy range. So it might have been 60 to 75% booked occupancy. And then it looks at the forward demand. So the pricing algorithm we use looks at how many people are actively searching and looking for the next 12 months. And that's how it benchmarks. So that optimal would be the maximum occupancy and conservative would be the low occupancy based on booked data over the last 12 months. So it's not a guesstimate, but it's based on live booked actual data.
Cool. Heath is asking, he's considering a property for short-term rentals. The advertisement shows a particular return. Can you run an estimate of what the estimated actual return and the occupancy rate can be?
Yes, definitely. So we would run that for the specific postcode and the specific property. And remember also we're segmenting our properties. Not every two-bedder performs the same. A premium penthouse on the waterfront would be quite different to an old red brick building far back in the suburbs. So we would band them, essentials, premium, luxe, different categories. So that's important to make sure.
Okay. Matthew's asking, is it better to buy a set of 4 units for short-term rental or one standalone house?
That's a great question. For us, we do see high demand for those multiples. We call them multis. So multis, you can almost set up like a boutique hotel. And you control the whole building. So there's no going to be any issues with restrictions, strata bylaws being brought in or complaints from neighbors. And then we also have the opportunity to target corporates where a group could be booking all 4 in one go. So if you can find one, definitely a great opportunity for multis.
Cool. I'm going to have to wrap it up, but one last question, Daryl. What's the usual cost of furniture for a 2-bedroom unit?
So it ranges. Again, we have different categories: budget, comfort, premium, and luxe. But it's sitting roughly between 15 to 18,000 as a standard comfort package. You can go lower or higher, but you can obviously according to your budget. But that's the rough range: 15 to 18,000 plus GST.
Okay. Great. Theo, any last comments?
No, I've noticed there's like 57 questions in there. So I really want to encourage, please don't hesitate to reach out to any of us direct. I'm sure any one of us individually will happily talk through potential scenarios. So if you've got any questions around how to structure it and, from a tax point of view, we can give general advice from the tax point of view, but I'll always keep directing you to your accountant, but we can plant the seed for the appropriate conversations on some of those considerations.
Can I finish maybe, Theo, for a question for you, just a quick one off the top of my head. Do you find it would be easier for someone to say, get approval to buy a property with a long-term rental estimate in mind and buy that and then convert it to a short-term rental, or would it be just as easy to buy and get the loan approval for something with a short-term rental estimate?
Yeah, so I don't think I quite explained that too well. That's essentially how you have to do it, in my opinion. So
Mm.
the pre-approval will not be based on a short-term rental estimate because it's too hard to forecast.
Yeah.
The point I was trying to cover in that initial slide was you need to factor in the long-term potential rent
Mm.
for your pre-approval and the serviceability.
And then once you've got it, you don't need to notify the bank that you've then switched it back to short-term rental because you're just managing it your own. You don't have, there's no obligation to tell your bank, hey, now I've got a short-term rental, right?
Not at all, but to my point about the historic rental income is what they use for servicing. You want to have at least 1 or 2 full years of rental income in your tax return for them to review if you wanted to refinance and do a cash out or
Mm.
anything of the sort. You need a good year or two of history.
Yeah, great. Well, Theo Chambers, Daryl Smith, thank you so much for joining the webinar today. Thank you for all our guests who've logged in and registered. As I said, if you do have further questions or like to take advantage of the offers we've got or just our services, please reach out. We'd certainly be delighted to help you. And yeah, really appreciate your feedback on these webinars and how we can help educate you and help you along on your property journey. But from here, we'll just say thanks. Thanks, Daryl.
Thanks, Rich. Thanks,
Thanks,
Theo.
Rich.
And thanks, Theo. And thanks again, everybody, for joining us. We look forward to seeing you again on another webinar. Bye for now.
Thanks, guys.